Good afternoon and welcome to our UB Alumni Webinar Wednesday series. On behalf of the UB Alumni Association and the UB School of Management, we are delighted you are able to join us for today's presentation. My name is Christy Fields and I oversee the Alumni Career Services Program here at UB. Today I am honored to introduce you to Dr. Supradeep Dutta, Assistant Professor in the Strategy Department at the University of Buffalo. Dr. Dutta will be sharing his research and expertise around entrepreneurship, innovation and growth, and how investors nurture the entrepreneurial ecosystem. This webinar will discuss the ways in which investors do, in fact, provide value-added services by influencing startup innovation and commercialization beyond mere capital infusion. Drawing insights from real-world examples and scholarly research, the webinar will shed light on the potential benefits and perils associated with sourcing funds from private equity investors and the challenges of experimenting with innovative ideas. Dr. Dutta received a PhD from Purdue University and an MBA from the Indian School of Business. I am aware that some of you have already submitted some questions, and we will leave some time at the end of today's webinar for Q&A with our presenter. If you have any questions during the webinar, please submit them through the chat question box on your screen, and we will do our best to answer those during the Q&A session. With that said, it's my pleasure to turn it over to Dr. Supradeep Dutta.
Good afternoon. Thanks to the UB Alumni Association for organizing the webinar and giving me the opportunity to share knowledge. And thanks to the audience for using your precious lunch hour in attending the webinar. Indeed, for many of us, this is the most productive hour in the day. So I will try to make it interesting and worthwhile. This webinar kind of provides a good platform to connect the rigor of academic research with the applications in the business world for entrepreneurs and managers. So today I'm going to share some thoughts on innovation and growth and how investors, in particular venture capital firms and angel investors, catalyze their entrepreneurial ecosystem and the challenges entrepreneurs and investors face in the process. Just to give you a brief background about me, I'm Supradeep Dutta. I'm an assistant professor at the School of Management. I had my PhD at Purdue University, and I teach the strategy capstone course at SUNY Buffalo. But before getting into academia, I have around 7.5 years of experience in manufacturing and strategy consulting, and I've been an entrepreneur myself, as well as consult a few entrepreneurial startups. In terms of my research is at the intersection of technology, strategy, and entrepreneurship that explores a central conundrum that the entrepreneurs face in terms of attracting resources when there is lack of information about the quality and credibility of the startup. One research strand examines the influence of capital funding sourced from private equity investors, crowdfunding platforms, and how federal grants impact the innovation and venture development. A second strand looks into research that impacts investors' decision-making behavior and how that impacts the innovation and investors' ability to create value. So I look into aspects of risk appetite and herd behavior in investment decisions. A final interest area considers the facets of information gaps that creates new opportunities for entrepreneurs, and at the same time, the anomalies of information differences challenges the entrepreneur to capitalize on the potential opportunities. So I look into the aspects of economic transactions related to mergers and acquisitions and IPOs. So in this webinar, I will share knowledge on 3 broad themes. So we will first start with defining who the entrepreneur is, then discuss various investment sources and how they differ, and finally talk about the challenges in the innovation process. So let's start by unraveling a myth. So who is an entrepreneur? So when I ask this question to the students or to managers and entrepreneurs, most of them say someone who takes a risk to start a business. And I believe most of you would agree with this definition. Entrepreneur.com says it's somebody who is synonymous to risk-taking, again drawing emphasis to the aspect of taking risk. Entrepreneurs are risk takers. This is a myth. Entrepreneurs are not risk takers. They are risk managers. The Oxford Dictionary defines an entrepreneur as a person who sets up a business or businesses taking on financial risks in the hope of profit. And I would like to change this definition. An entrepreneur is a person who sets up businesses managing the financial risks in the hope of profit. Now, I agree entrepreneurs do take some risk. For example, the opportunity cost of being employed, risking their reputation, but they hardly take financial risk unless they are completely self-funded and are operating the business profitably, which is a rare phenomenon. So who bears the risk? It is someone who invests in your idea, someone who takes the financial risk. It could be your family and friends. It could be the backers in the crowdfunding platform if you are sourcing funding through crowdfunding. It could be angel investors who are individuals or group of people coming together to invest, and most of them are accredited investors. Or it could be the venture capital firms who invest in the startup. And typically, angels and VCs fall under the category of private equity, which is a more formalized way of investing in new ventures. In the next couple of slides, I'll focus more on this formalized nature of investments, particularly on angels and VCs. So let's take a hypothetical example to see how the startup funding works. Say, for example, you have a business idea and you share the business idea with a friend and you team up as a co-founder. Initially, the founder and the co-founder may put some of their own funds to kickstart the project. You may borrow some money from family and friend, and say you have $15,000 to start the business. At this stage, you own 100% of the company, but the company is valued at zero. So basically, you own 100% of nothing, and you have already incurred a cost of $15,000. So as you continue through the struggle of garnering resources to implement the idea and sustain it, you look for funding. You look for people who have the right expertise and network. Although access to financial resources is the pivotal aspect for any startup, it is equally, if not more important, to efficiently utilize the capital in the right direction. So simply taking a bank loan may not help. And in general, banks are wary of investing in something that lacks credibility. And as you continue to seek investment, you have to shell out a portion of the pie. And that is the cost an entrepreneur incurs when they are partnering with angels and VCs. I agree the valuation of the firm also continues to go up under different series of funding. But here's a word of caution. It may not always be a good idea to have multiple investors with different contracts. The messier the investment contract gets, it becomes difficult to attract established investors in future because the cost of cleaning the contractual mess is high. So by the time the business, if everything goes in a successful way, reaches the IPO stage, which is typically considered to be a home run for the investors, the founder may have just 15 to 17% of the firm. But that 15 to 17% of a big firm is way more than 100% of nothing. And how much time it takes from idea to the IPO stage varies by industry. It varies by the type of technology, as well as it is idiosyncratic to the founder and the founding team. So the active support and advice provided by a venture capitalist is often embodied in their role as a board of directors. For instance, they are directly involved in recruiting the top management. They leverage their networks in the industry to identify R&D partners, potential suppliers, and customers. Also, such investments receive a lot of visibility. The media covers such investments in a good way. This helps other people and other companies in the market to seek partnerships. They also use the network in M&A deals, identifying the right buyer and share the right information about the potential value of the firm. And these aspects kind of alleviate the concerns around the quality of the startup the legitimacy of the founder, and that may influence new product development and its commercialization. So technology-based ventures face considerable risk as they innovate while assessing the technological feasibility, the business model credibility, and the product or service viability that severely limits capital resources. Yet, angels and VCs fill this need by assuming risk alongside the founders. So capital infusion is one important way that fuels innovation that would not otherwise occur. A second way private equity investors might fuel innovation is by actively engaging the founders and providing proper mentorship around the development and production, and connecting them to the key talent in the industry, leading to a successful commercialization. So accordingly, it is believed that private equity provides more than just capital to the technological entrepreneurs. While the angels and VCs have a close resemblance, as they are both private equity investors, their approach towards investments and the structure of the investment is very different. And the primary difference is the source of capital. Angels invest their own money, whereas VCs create a fund by seeking money from institutions like pension funds or high net worth individuals. And those are called limited partners. And because VCs are investing someone else's money, they need to be more structured in terms of the contract system and the governance mechanisms. And typically, VCs try to give 20% returns to the limited partners. And if they're not able to do so, it kind of hampers their reputation and it makes it more challenging for them to raise funds in the future. And relative to angels, VCs are more stringent in terms of the contractual mechanism, where they take most of the decision-making rights, and most of the time they sit on the board. Angels, on the other hand, are more flexible and take a more hands-on approach in the contract mechanism. And compared to angels, VCs are very time-bound. Because they are answerable to the limited partners, they want to maximize the returns in a short span of time, say around 5 to 7 years. And VCs have a more extensive network in the industry compared to angels. They have more access to resources and typically invest in larger amounts. But in the US and across the world as well, angels have started forming groups, and that allows them to raise larger amounts as well as share the risk across the members of the group. I just wanted to give you a brief snapshot of the private equity investment that's happening in the technology sector in New York State. So over the last 5-6 years, around $20 billion have been raised across 3,800 deals, and mostly located in New York City, but this data is across New York State. And the growth has been pretty sharp in terms of investments in startups. And most of these investments are happening in the early stage deals. So if you can see, it's generally 55 to 60% of the investments are in the early stage deals. So who are the most active investors? And these are pretty established names. For example, Union Square Ventures and Axel Partners, they are very strong in New York City as well as in the California region. And in terms of active angels, David Cohen is a very active angel investor. New York Angels has a very strong network of angel investors across New York State. And 37 Angels, they specialize in investing in women entrepreneurships, women-founded firms. They focus on that. And in Western New York, Rand Capital is a pretty established VC firm, and they're pretty active in this region. And Buffalo Angels Network is doing good work. And the other firm is Buffalo Capital Partners, which have raised a fund last year, I think. So if anyone is interested in connecting to a VC or to an investor, I would suggest you join these associations called UVANI and Western New York Venture Association. So these are platforms that help you connect to the investors. They hold networking meetings every quarterly, every month, and they keep sending emails. So that's a good platform to get started if you want to get connected to the right investors in the Western New York region. So going back to the differences between angels and VCs, given they are structurally very different and their approach is very different towards innovation and towards the investment, these differences can impact the way they influence a venture's innovation. In many cases, investment by angels or VCs might be viewed as complements occurring simultaneously or sequenced, where the VC invests after the angels. And in some way, they may be substitutes, providing a similar value to the startup. For instance, in academic research, we have generally focused more on the VC industry and how VCs influence innovation. And what we find is VC-backed startups generally have a higher innovation rate compared to startups that do not have such VC investments. So one of my research attempts to ascertain whether angels and VCs have similar influence on innovation, or are they different? It may be that angels contribute less to spur innovation compared to VCs, or it may be that angels contribute more to spur innovation compared to VCs. But the research found that both angels and VCs equally influence the innovation rate. In this sense, the value of angel and VC investment may seem to be substitutive in nature. However, we found that the impact of the innovation is way more for a VC-backed venture compared to an angel-backed venture. The VCs have a far superior impact on the innovation compared to angels. The difference between angels and VCs may also influence on how fast they are able to successfully exit from the startup through an IPO or M&A. And what we find is that compared to angel-backed startups, VC-backed startups take a way shorter time to exit successfully. So in some way, VCs and angels can complement each other to create more value and catalyze the innovation of the startup. Traditionally, angels were thought to fill the niche between friends and family and formal VCs. And increasingly, it is recognized that investment process is not really that sequential in nature. This is partly because the growth of angel groups, which tend to invest slightly later than individual angels and can pool in the capital, facilitate a larger investment, very similar to VCs. And VCs have also dramatically shifted the proportion of investments to early stage ventures. So consequently, angels and VCs often invest in the same stage of venture development. So with the growing access to alternative sources of private equity, entrepreneurs have a choice between the source of private equity that may be guided by the aspect of the financial offering or by the value-added benefits that each investor provides. So instead of simply looking at the investment amount, entrepreneurs should give a deeper thought in terms of the benefits and cost related to the type of investor before accepting any investment deal. And that cost, there's a trade-off in that on the value and the cost aspect. The entrepreneur needs to realize whether the investor has the expertise in the core business, in the technology the startup is pursuing. And many times investors are specific about the area of investment because they can see how they may add value. Another way investors influence is through their networks. More established investors have a larger network they can leverage to garner resources, but the entrepreneur has to incur a higher cost to partner with such an investor because they will have lower valuations. Another potential way the value comes is from the reputation of the investor. Investments where reputed investors are more visible in the market, that kind of provides a certification about the quality of the technology. But ultimately, it's the aspect of trust between the entrepreneur and the investor, which is kind of critical. And talking about trust, here is a little video that reflects on trust, kind of on a lighter note.
Hello?
Honey? Are you at the club?
Yes.
I'm at the mall now, and I found this beautiful leather coat. It's only $1,000. Can I get it?
Well, sure, if you like it that much.
Okay. I also stopped by the Mercedes dealership and saw the new model. You know, the one I really
How
like.
much?
120.
Well, at that price, I want it with all the options.
Great. Oh, and one more thing. The house we won last year is back on the market. They're asking 1.5.
We'll make them an offer. But come in at 1.4.
Okay. I love you, baby.
I love you too.
Okay, bye.
Does anybody know whose phone this is?
So you get the idea of trust in this aspect. That's a critical aspect when you're partnering with an investor, both from the entrepreneur's side as well as from the investor's perspective. The way an investor looks into the startup is very different from the way an entrepreneur looks into their business. Entrepreneurs generally have a more linear projection of their valuation, whereas valuation by investors is contingent on different milestones achieved by the startup. For example, in the biotech industry, the valuation goes up if the startup has patents granted. The valuation changes if they have successfully got the clinical trials done, and if they have ultimately achieved the FDA approval. So most ideas can be imitated, and most VC firms invest because of the founding team, and that forms an important factor in determining the valuation. Other important aspect that VCs give weightage to is how much funding would be required to successfully exit from the investment, how big the potential market could be, and that kind of relates to the concept of network externality. Let me show you an example of how the valuation is done from a post-money valuation and a pre-money valuation perspective. So pre-money valuation is the value of the firm before the investor puts money, and post-money valuation is the value after the investor decides to invest. So I hope some of you guys have watched that Shark Tank episode that airs on ABC Network, where investors pitch in their idea and where entrepreneurs pitch in their idea, and 4 to 5 investors make kind of investment decisions. So say, for example, there's one offer on the table that says, I'll give you $25,000 for 20% of the company. And a second investor says, I will give you $100,000 for 50% of the company. So the post-money valuation is 25,000 by 0.2. It's $125,000 for offer 1 and $200,000 for offer 2. The pre-money valuation is 125,000 minus 25,000 is 100,000. So the pre-money valuation is kind of same for both the offers. So generally the investors have kind of similar pre-money valuation. It is the post-money valuation that varies. Related to market size, to ascertain how big the business opportunity is, let's consider some examples on the business ideas based on the sharing economy that is disrupting established industries. With things getting more mobile and digital in nature, the aspect of sharing economy has created many new business concepts. For example, Airbnb. It is a business about sharing your home. It's currently valued at $30 billion. It is disrupting the hotel industry. It is valued more than Hilton hotels. Yet, it does not have a single asset under its name. Then another example is Lending Club, platforms which are giving loans by sourcing it from the crowd. It is valued at around $8 billion, and it is kind of disrupting the bank loan industry. Then we have the ride-sharing companies like Uber and Lyft, valued at $40 to $60 billion. They are disrupting the taxi service and the car rental industry. So an important parameter that investors and market kind of looks for is the growth in the number of active members. And it has been shown that there's a strong correlation between the number of active users and the value of the firm. Although this is not a very good performance metric, because not all active members really contribute towards generating revenue for the firm. And that's why it kind of you can see why WhatsApp, which is just a simple messaging app, was valued at $19 billion with zero revenues. It's because of the exponential growth in the active membership. And why you see Twitter's stocks kind of going down, because the growth in active members have kind of remained stagnant over time. The underlying concept of active membership is the idea of network externality. So what is network externality? It is the enhanced value a consumer gets from a product or service when more people purchase the product or service or use that service. For example, we join Facebook, or we join Twitter, or we join Snapchat because our friends and family are there on that, and that adds more value to it. So let me give you a good example from the economics behind QWERTY, the keyboard design. So the QWERTY keyboard design came into being because of network externality. Because QWERTY came in first, they could tie up all the typists and the typing manufacturers, and the typists learned typing on QWERTY keyboard. Although Dvorak simplified keyboard, the DSK keyboard, which came in later, is way more efficient than the QWERTY keyboard. It could not make its way into the market because the typists did not want to learn something new, and the typing manufacturers did not want to set up a new design, a new layout for the keyboard. And that's where a network externality aspect allowed QWERTY to be used as a keyboard design instead of the DSK, which is more efficient. So how innovative ideas come into being? Central to understanding the innovation process is the idea of experimentation. And experimentation has kind of two facets to it. One is the aspect of uncertainty. You really don't know whether it will be successful until you start it. And the second facet is the aspect of learning. In the process of experimenting, you continuously learn what factors are working and what may not work. And this helps the innovator to update their belief about the potential success of the innovation. Now, investors face this dilemma as well when investing in radical ideas. And unless you invest, you don't learn whether it will be successful. And with this fear of uncertainty, and many times they let go of a potential innovation that turns out to be a huge success. For example, Bessemer Ventures, a highly reputable and established venture capital firm, and Felder Hardiman is a partner in the firm. So in 1982, he was approached to invest in Compaq and Lotus. And Felder said, Lotus wasn't proven yet, and I was worried about the situation there. As for Compaq, there was no real future for transportable computers. So he was talking about laptops. So that was back in 82, and they let go of this investment. Whereas on the other side, Genentech in 1976 was one of the first companies that attempted to market products based on the revolutionary recombinant DNA technologies that was emerging from the medical labs of Stanford and University of California, San Francisco, which kind of kick-started the biotech industry. Kleiner Perkins is a reputable VC firm, was approached with the initial investment. And this was a totally new technology field. So two key questions needed to be asked. Could a strand of DNA be spliced open at a precise location at the beginning of a gene? And if that was possible, could the modified DNA molecule then be closed back? And before fully committing money to Genentech, Kleiner Perkins and his collaborators contracted out these questions to two specialized research outfits. Only after receiving a positive lab result did they go ahead and commit $3 million to the investment. So this aspect of experimenting, kind of colloquially referred to as spray and pray investment approach, has become more of a prevalent in the venture capital market. And these examples kind of highlight the challenges faced by investors related to financing experimental ideas, products, and technologies. So Friedrich von Hayek, who won a Nobel Prize in 1974, quotes, "The solution of economic problem of society is always a voyage of exploration into the unknown." and the attempt to discover new ways to do things better than they would have been done before. So there is from an investor standpoint, financing innovative projects demands a balance between exploring new ideas that are highly uncertain, as well as exploiting projects that kind of give you a more definite outcomes. So you need to balance the aspect of exploration and exploitation. So when you're experimenting with new ideas, there is a high likelihood that it will fail. And only a small percentage of innovative projects end up being successful, and that too after multiple iterations. But our view of entrepreneurial success is kind of biased. And why it is biased? Because we only see the successes. Media glorifies the success stories, and we hardly know about the failures. To show you this biased approach outlook that we have, let me show you some examples of well-known brands that we use or have used in the past. LinkedIn. So it was started in 2002 and went to IPO in 2011, a successful venture valued at $5 billion. Last year, Microsoft acquired it for $26 billion in cash. So Reid Hoffman is the founder behind LinkedIn. So before co-founding LinkedIn and investing in big names like PayPal and Airbnb, Hoffman created what is called SocialNet, an online dating and social networking site that ultimately failed. But we don't know about that. Let me give you another example. Dyson. It started in 1991 based on the Cyclone technology that currently employs, and the company employs around 7,000 people. It's based out of UK. And Sir James Dyson, who is the inventor behind it, and he wasn't always well-known, a well-known name associated with vacuum cleaners. In fact, it took him 15 years and all of his savings to develop a bagless prototype that worked. And he made 5,000 more prototypes that failed first. But we don't know about these failures. A third and very common example is Amazon. Amazon started in 94, went to IPO in 97, valued at $300 million, and is currently valued at around $400 billion. And indeed, it is one of the world's most remarkable firms, and it is just getting started. But Jeff Bezos, Amazon is just one of the biggest success stories for the online era. Before Amazon became a household name, Jeff Bezos had several failed ideas. And one of the most notable ones was an auction site which evolved into like Z Shops, a brand that ultimately failed. So you can see the failures that's behind these entrepreneurs, but that we don't know. And most radical ideas generally fail. It is a very small percentage of them that end up being a success, and we generally see that. So I want to end with the final thoughts for the entrepreneur or the innovator. The only people who don't make mistakes are those who aren't doing anything. So the idea is to fail, but fail fast. If you fail fast, you have time to work on a newer idea or something different that may work. It is more about managing the risk. So some fail early and most fail often. And almost all of them will fail again. But something deeper occurs as a result. Failure provokes learning. And the second thought is for the investor. Take big risks, but take them very carefully. So take more of a calculated risk. So thank you for your time. If you need any advice or help, or if I can be of any help to you, please feel free to contact me. With that, I turn over to Christy for any questions.
Excellent. Thank you so much, Superdeep. We really, really appreciate you taking the time to share your knowledge and expertise, and really interesting to see some of those successful startups and to hear a little bit more about the failures that came first and how we can all go about managing those risks moving forward. So very appreciative of that. As Superdeep said, if you do have any questions, I know There was a lot to digest and a lot of fantastic information. We will be able to get all those questions to Super Deep, so feel free to let us know. We're going to be sending an email out following the presentation, and that way we can go ahead and share with you an email address that you can reply to with any questions that you may have, and we can get those to Super Deep, and we'll get those answers to all of you as soon as possible. So we will make sure we do that. So just want to say thank you again to Super Deep, and on behalf of the UB Alumni Association and the UB School of Management, just a really big thank you again. We have recorded this webinar, and we are going to send you the link within the next 24 hours, just as I mentioned, along with that email address where you can submit any additional questions. And we also want you to save the date for Wednesday, April 5th. As Lori Metzger, who's a clinical assistant professor in the UB School of Management Accounting and Law Department, will present on data analytics and accounting. And we will share all the additional details for this webinar and the registration link in our follow-up communication. And then in addition, we do have some other upcoming webinars on the following topics: adaptive organizations, the Affordable Care Act, what comes after repeal and replace, Sugars 101, all sugars are not created equal, sustainability and the supply chain. The UB Libraries is going to have an archives showcase. We're going to talk about generations in the workplace, as well as venture debt and due diligence for business, plus Google Ninja tricks. So those are our upcoming webinars. So with all of that said, again, a big thank you to Super Deep. Thank you for taking time out of your lunch hour, or maybe if you're taking time out of your coffee hour in the morning on the West Coast, or maybe your evening hours globally. Thank you again, and we do hope you enjoy the rest of your day.